Okay, so let's draw another line here, change the color just to keep it interesting. So when we're talking about a secured loan, okay, let's start with that idea. A secured loan simply means that there is some form of collateral that backs up the loan. A very typical example of this is a house, a mortgage on your house. Sorry, that's a terrible house. When you borrow the money from the bank you give them a mortgage, right? And part of that whole mortgage documentation that you sign at closing gives them an interest, a security interest in that house, the bank. This is the bank. So, what happens if you stop paying on your mortgage and the bank wants to foreclose because you're behind on your mortgage payments? What that means is because the bank has a legal right to that house, if you stop paying your mortgage, they can come, essentially take over your house and sell it, and hope that they can get enough money out of that sale to pay off your loan. Okay, so that's called a secured loan. Now, secured loan can also, most car loans are secured. So larger purchases like that are typically secured loans. They are backed up by collateral. Okay. Now, in an unsecured loan, okay, some examples of unsecured loans might be even student loans. When you sign a student loan, you don't have to sign away your home or your car, or you don't have to pledge your a retirement account or anything. They're just when you get a student loan from the government, they give that to you without any sort of collateral. Consumer installment loans. So I know it's a lot of big words, but basically the consumer installment loan is you've seen the 90 days same as cash, or buy now and you'll have no payments for 12 months, that kind of thing. Maybe it's for appliances or furniture, things like that. So a consumer installment loan, typically when you do that kind of loan, the lender isn't going to take a security interest in your couch or your television or your dishwasher or that kind of thing. So that's called a consumer installment loan, and typically those are going to be unsecured. Okay, and then credit cards, of course, are a very popular form of credit, and those are unsecured. So in most cases, now there are some forms of credit cards where maybe they are backed up by cash in a bank. Those are very specific kinds of cards for people who are really trying to repair their credit. So we'll get into that in another video. But most credit cards are just issued to you based on your credit score and your credit history. They are unsecured, and if you default on your credit cards, you might get sued, and you might, if the credit card company gets a judgment, they may be able to come, collect on that, by forcing you to sell some assets or that kind of thing. But they don't have a legal immediate right in your home or your car or anything like that. Okay, so those are really examples of both secured and unsecured loans, and then we've kind of gone through almost types of loans as we've gone through this conversation also, with a mortgage or a car loan as your typical unsecureds, student loans, consumer installment loans, and credit cards as being types of unsecured loans. Okay, so credit cards, those are the ones that are most popular, especially with young people. You get tons of opportunity to get credit, especially as you start getting into college. And of course, the credit cards give you a great ability to essentially borrow money to pay for, household expenses, trips to Target, things like that. Personal needs. Maybe it's going out to dinner and that kind of thing. And again, it's convenient. It's maybe even safer than running around with a pocket full of cash and that kind of thing. Okay. Now let's break out home loans for a second, because I want to make sure that we cover a couple different types of home loans. There are three kinds of loans that we'll talk about really quickly. One is just the purchase loan. A second time would be a refi or refinance loan. And the third kind, you might even hear it referred to as a HELOC or a home equity line of credit or an equity line. Okay, so essentially, just to cover these really quickly, a purchase loan is what it sounds like. This is the initial loan that you might take out when you purchase a house. So you go out and you find the house. You put let's say the house is $100,000, right? And we have 20% down. So you put down $20,000 down. You borrow $80,000, and the total is $100,000. Okay, so the initial loan is this $80,000 right here. Okay, that's all well and good, but let's say that you borrowed that $80,000 when interest rates were at 7%. Okay, but now interest rates have fallen. Let's say they've come down a little bit, and now interest rates are at 6%. Oops, I meant to change the color there. Sorry about that. So now interest rates are at 6%. So it might make sense to refinance your house to take advantage of the lower interest rate because you're going to save a lot of dollars over time with a lower interest rate. So that's called a refinance loan. That's when you take this $80,000, which maybe by the time you go and refinance it is actually a little bit lower if you've been paying on this initial mortgage, and you essentially refinance the house. And so that just means really a second loan. Now, I don't mean additional. When I say second, when you refinance the house, you pay off this initial one. This initial one that goes away, and you refinance it with a new one. So maybe a better word is new or replacement loan on your house. Okay, still fully collateralized. It's still a collateralized loan, but it's just a refinance. It's just giving you an opportunity to refinance your or take out or pay off your first mortgage, your original mortgage, replace it with a new one at a lower interest rate. Now, this home equity line of credit, this deals with this piece right here, this $20,000. Remember, you put $20,000 down on your house. So what that means is you've got this loan, whether it be your original purchase loan or a refinance loan of 80, and that just stays out there. So you've got a primary loan of $80,000. But let's say that you want to do some home repairs and you go to the bank and you say, I'd like to get $10,000 to fix up my kitchen. They will offer you a home equity line of credit. Okay. And essentially this works kind of like a checkbook. They'll say, well, okay, we're going to look at your credit score. We're going to say you're good credit risk. So we'll give you that $10,000 line of credit. Hey, it's not a loan right away. All it is it kind of works like a checkbook that you have to repay. So when you go to Home Depot to buy your first supplies for your kitchen improvement, you'll write a check on this home equity line. Let's say you spend $1,000. So now you've got $1,000 on this home equity line, which means, of course, you have $9,000 left available to borrow. You're never required to borrow it. It's just there if you need it. Okay. You are, however, required to repay it. Now, it turns out also that home equity lines of credit are also collateralized, right? They have a position, a secured interest in your house. So again, if you default on this loan, even if you are paying your primary loan, if you default on this secondary loan, the lender for the home equity line can come foreclose and take over your house and sell it. And then when they sell it, they'll pay off whatever's remaining on their loan. Let's say it's the $1,000, and then excess will go to pay off the primary loan of $80,000 next. Okay. So that's home equity loans in a nutshell. So we've talked about secured versus unsecured. We've talked about the three types of loans, and of course, the last thing which we alluded to earlier is the cost of loans, and that's really what we all know, what everybody's heard of as interest rates. That's the cost of borrowing money. So whether your interest rate is 7% or 6% or 6.25% or 6.5%, that's just the amount of money that you pay every year on the amount left remaining. And don't worry if this is going kind of quick. We're going to have a secondary video just that covers interest rates by itself so that you can kind of learn how to calculate them and how to calculate your mortgage payment and that kind of thing. Point here is just to give you a sense of some of the basics of borrowing and cost really being interest rate. Okay, so we'll see you in the next video, and we will cover a little bit in more detail some, how to look at interest rates, how to calculate them, and really how to see the difference between a lower interest rate and a higher interest rate. Okay, thanks very much. We'll see you in the next video.